up after the policy. We also have Ajay Srivastava joining us now from Dimensions Corporate Finance Services to take some questions on this. Ajay, thanks a lot for joining us today. This is Pavitra. You know, your first thoughts on a bit of this surprise pause that came through from the Reserve Bank, and also the commentary, because, you know, there is still caution in the comments, right, that came through. So how do you look at this? Also, on the pause, do you think that this is going to be an extended pause for some time?
Of course, good morning. Of course, it's going to be extended pause, because the central bank, I don't think, take decisions that, you know, you will pause in one policy and just the next policy you're going to increase it. I don't think that's going to happen. In the backdrop of a high inflation number, which had just come in February, he's still taken the call to heat the industry, to heat the markets, to heat the general chorus saying interest rates are too high. And also remember, this is a very crucial, in the next 12 to 18 months, the most crucial political period for the government as well. So I think it's running in sync with what the government wants it to do, is to cut the interest cost at least down, or at least not let it go up. And also railroad the investor, the depositor sitting on the sidelines, to say, let me go capture the bank deposit rate. So I think I think he's played a gamble. It's going to be a big gamble, because he is still not taking the inflation down to the 4% even in the last quarter of next year. So if you're an ordinary person, I think this policy will hurt you. It will really hurt you. If you're a corporate, it's going to do wonders. For the bank, extremely good policy, because now the people who are sitting on the sidelines are going to open their fixed deposit and say, let's lock in this rate. So I think for the corporate world, it's pretty good news. If you're an individual in the country where the central bank has lost the fight to inflation, or the will to fight it, I think it's a bad news in longer term, because you will pay a much higher price for inflation going up, given the policy announcement today. So, well, the market is all about corporates, so we're going to see positive reaction.
That's why they say, right, Ajay, good morning, you said a consumer who invests in corporates through stock markets, right? So you get both, at least some balancing. Ajay, but, you know, so what does it mean for markets, stock markets from here out? If, you know, we'll keep debating whether this is an extended pause or a limited pause, or they'll change their minds again. For example, we get US labor data. I mean, all economists we've spoken with have said, Indranil of CLSA yesterday told us that what you need to watch is what the Fed does, because what the RBI does will depend on that, because the impact comes through via the currency channel, etc. US data has all been weak for the last 3-4 days. We get jobs data on Friday. If it is in line with the weaker data, rest of the data, all is well. If that comes very hot, then you got a bit of a problem once again. So it's up in the air. What does all of this mean for markets, in your opinion?
See, if you cut it down very simply, Prashant, all the chatter, the point remains that Indian economy is pretty insular from the global to a large extent. Rupee dollar has been, thanks to the weakness in dollar, has been static, so that big pressure is off. Your import pressure is off, because slowing economy, you're importing less. Oil is not reaching anywhere close to 100 at this point of time. So all in all, for an insular economy like India, the domestic rates, and he's taken a call very clearly that the Fed increased the rate, but he's not increased the rate. Every single central bank increased the rate in the last 3 weeks, except now India is the only outlier who's not increasing the rate. So I don't think Fed dependence is going to be the important point. I think for his context, the more important point would be the fact that there is a pressure not to let the rates go up, number one. Number two, the pressure that get funding for the banks from the depositors. I think two big pressures are working in the system. Inflation not going up is a generic issue, but interest rates are so visible. You don't really feel when you buy extra milk or 2 rupees, etc. But when all the EMIs go across, it's national news. So, in an election year like this, that's something that the government can ill afford. So I think he will go this path, irrespective of what happens to the inflation, irrespective of whether Fed is very hot or lukewarm labor rate, doesn't matter. The call has been taken today, and it has to be followed through. Otherwise, your central bank will not look, like a decisive central bank. It will just say, you walk in and you walk out. It doesn't work this way. So my belief, he's taken the call. He will walk the path for next 12 months, irrespective of what happens to the Fed, and he will take the risk of whatever it is. And I'm sure some question and answer would be asked that you still have not targeted inflation to go below your mandate of 4%. Why is that happening in the country? So that's where I said that I think it's a more election year will ensure the prices will not go up, interest rates will not go up. So this call is taken for keeps, in our view, for the next 12 to 18 months.
Okay, this call is going to perhaps be in place for the next 12 to 18 months, and we're all, believe me, waiting by for that press conference at 12 to see if he does answer those questions on inflation as well. Ajay, in this context that you're saying that for the next 12 to 18 months might probably hold at this, how do you look at the banks, and where do you look, for opportunities within the banking pack?
Banks definitely will be a positive at this point of time, as I said to you, because they were the last people who were really clamoring about that. We depositors are going to mutual fund. That was taken care of by the finance ministry. Now the next issue was people were sitting on the sideline. So this should put them. So I think for the bank, in spite of the fact that the loan rates will not go up dramatically, is going to be a great positive. And the reason there'll be great positive also because the fact that the external environment is so weak in terms of availability of debt, that some of the refinancing which will happen will be domestic debt, I think, in this part of the year. So you feel much less people going to borrow abroad. It's not going to be easy. So banks are going to have a good run. Now, the question is whether it'll translate to the stock market performance. I think that's the challenge the banks have, because as an equity, everybody is over invested in the banks. So the room for growth in terms of PE expansion is limited because everybody owns it. So it's not like, you're expecting 12 or 15%. It's not like the pharma sector. It's not like the other sectors. Everybody owns it. How much more can you own the bank? I think, and that's a crucial question going to come in the market. So, yes, it's positive for the banks. The banks will grow. The profitability of the banks will definitely grow in the meantime. There's no doubt about it. They will get a little higher rating. But whether it translates to an above the market return, that I'm very doubtful, because given the nature of overinvestment in the sector. So I doubt that banks or banking sector will give above average market returns. Maybe the index will give you better return than the banks in our view, but it will be definitely positive, but looks to be less than the index.
The market's cooling off a little bit. We're back under 17,600. We were at that 17,615 level. We crossed that by 1 or 2 points, and then there is a bit of a pullback. I'll just stay with us. More questions coming your way. We'll take a quick commercial break. Continue our discussion with Ajay, and of course more market participants who continue to join in with their perspective on this important RBI pause. Stay with us.